Hi there, and welcome to this lecture. This is week 2's content on the PRA and FCA's principles of authorising firms and individuals, and welcome to part 1. Before we go on to this week's content, let's look back to last week to ensure we know what we covered. So we talked about what is regulation. We looked at the difference between principles-based and rule-based, and how one is more discretion and the likes of rules-based being more followed to the letter of the law. And we also looked at the principles of good regulation, and we covered the 8 different types, such as being efficient, allowing for sustainable growth, giving senior management responsibility, the recognition of how different businesses operate, the openness and disclosure issues regarding regulation, and overall transparency. And then lastly, we talked about proportionate, to ensure that any rule or regulation put in place is not overly burdening them for the firms. Now this week, we are going to discuss how the likes of the FCA and the PRA authorise individuals and firms, respectively. Now this might seem UK focused, but as you can imagine, these processes, albeit we'll cover from a UK point of view, these processes are very similar in various parts of the world. And as some of you will hopefully face in the future, you will go through this process of being authorised irrespective of which country you go on to conduct your career in the financial services sector. So we will look at the kind of principles and the concepts that regulators use to authorise individuals. We'll go through the different types of authorisation that's needed for staff in different parts of the organisation, because some colleagues, for instance, at the lower level, might not need as much authorisation as someone at the top or the CEO. Then we will look at how you potentially maintain this authorisation. As you can imagine, it doesn't just happen at the start of your employment, it is continuous and throughout. And then we will look at how the PRA would authorise individual firms to work within this sector. Now let's start by looking at the authorisation process for individuals. Have a look at these pictures. Specifically look at the bottom left. Now granted, this isn't very diverse at all. The industry is certainly cleaning up its act when it comes to diversity. But what are all these people doing? Now I don't know when this picture was taken, but I'm guessing this is after work. But historically, in the City of London, you might have seen this at lunchtime. And you're probably sitting there thinking, well, that's not really good behaviour at lunchtime. They're sitting drinking alcohol. Well, actually, only until recently, individual firms have introduced certain policies about drinking alcohol during work. And it's actually not something the regulators have really sought to address, but mainly been driven by individual firms and the image that they want to show. So in this section, we're going to talk about how firms follow the regulations to authorise individuals. So when did this actually start? Well, prior to the Markets Act of 2000, I want you to have a search now whether there was actually any regulations in place. Could anybody just get involved? What happened before the Markets Act, before the Financial Services Authority came into place? I'll let you do some research on that. Following the Financial Services Market Act and the introduction of the Financial Services Authority, there was the introduction of 2 types of authorisation for employees and individuals who worked in controlled functions, which we'll cover later on, and a fit and proper process for individuals that work within the firm as well. And as we talked about last week, when the FCA was disbanded and replaced with the 2 sort of regulators, the PRA and the FCA, they took over the fit and proper process. But this has now been changed as of 2016, so you still have kind of fit and proper or a deviant of it for junior members of staff, but there's additional requirements for senior management, known as the senior management regime. Now let's look at fit and proper. Well, what does that actually mean? So the concept was that management and individuals had to demonstrate the three key words here: honesty, integrity, and have a certain reputation. So what does fit and proper actually mean? Well, these principles still exist today, but originally the concepts were you had to demonstrate that you were honest, you had integrity, and you had a good reputation. You had to make sure that you're competent in the role you're doing, and that you have the capability to achieve this role, as well as your own personal financial soundness. But do you know who these three gentlemen are along the bottom? Have a guess now if you don't. We'll go from left to right. Now the first one is Bob Diamond, and he was the chief executive of Barclays, and he lost his job post the financial crisis. Now, was this person fit and proper? I'm guessing he would have passed all the Financial Services Authority's test for fit and proper, but yet he overseen three major scandals at Barclays before losing his job, such as the libel rigging scandal. Barclays were heavily involved and accused of being the main perpetrators of rigging libel, and we'll cover this within the module later on. There was also an issue about Barclays and how they tracked tax between the US and the UK. There was also a lot of consumer pressure on Barclays, how they treated small businesses and some of the products they sold to small firms that lost out during the financial crisis. Prior to the crisis, this person was held in a lot of esteem. I believe he was even knighted. But post-crisis, he was rather disgraced in the media. And quite a lot of the honesty, integrity and reputation that he once had disappeared. The person in the middle, this is Adam Applegarth. Look him up. This is the person that overseen Northern Rock really since it became a bank from a building society up until its downfall in 2008. And we'll cover this case study as well in the module. I'm assuming he would have also passed these tests. But this person used to work for Walmart. He followed some of the same principles that Walmart had in the old days into the banking sector. So, was he competent at running a bank when he came from a supermarket? So all these questions we could explore. And our final person on the right, this is Raj Ranjarathman. Now he probably wasn't authorised in the UK as he did most of his work in the US, but they would have followed a similar process. And again, these principles would still be the same. They have to be honest, integrity, have a good integrity and a reputation. Well, this person in 2011 was convicted and put away for 12 years for insider trading. In the week 6 folder, you'll see a YouTube video on how to catch a trader, and we'll cover this in the module, but it's worth a watch and it explains the process of how this individual was caught insider trading. So given what I've just said, do you believe these to be fit and proper? Have a look to see what they do now. Obviously Raj Ranjarathman is still in prison, but probably will be subject to parole from next year onwards. But the other two, what do they do? Chances are they're probably an advisor of some sort. So let's look at the tests now. Let's think about this. How would you go about demonstrating that you're honest, you have a certain level of integrity, and a good reputation? Write a few things down now that you believe would satisfy such a test. Now to start with, think about if you apply for a job in the financial sector. What will your future employer ask you? They'll probably ask you for a reference. And in this reference, somebody will obviously try to demonstrate that you have a certain level of integrity. They might potentially do a DBS check to see if you have any criminal convictions. More specifically, they'll be looking at where financial crimes involved. They'll make sure that you've never been involved with the likes of money laundering or market manipulation or insider trading. They might also look at if there's any civil cases against you. And lastly, you might even get credit checked, but we'll come on to that a bit later. But also, you guys will be applying for placements and potentially grad jobs in the future. And them tests that you get given, the psychometric tests, the reasoning and judgment tests, the situation tests, they're all kind of examples of testing your honesty and integrity, because some of these tests are designed to ask the same question twice, just in a different order or a different perspective. And the idea is, if you maintain your integrity and honesty, you'll answer the question right twice in a row. But sometimes you can easily get caught out by them, which, I have to be honest, happened to me in the past numerous times. The next test is about your competency and your capability of actually doing the job you've been employed to do. So think about now, how do you think you can satisfy that you're competent in what you're about to do as an employee? Specific to the FCA, they have a handbook of how employees at different levels and the sort of levels of training that's necessary for their own development and ability to fulfill their task to a capable manner. Depending on the role you've been employed for, of course, they're going to look at your employment history to see if you have experience. Have you worked in certain controlled functions before? Have you been subject to fit and proper process in the past? If you have, of course, they're going to look at your potential past performance and get suitable references from former employees. If you're brand new into a grad scheme, then of course it's going to be a very different process, and they're potentially going to look at your former qualifications. In addition to the likes of the FCA's process, there's also additional requirements from MiFID II. And MiFID stands for the Markets in Financial Instruments Directive, which is European Union level of requirements. And this came into force in January 2018, which is specific operational risk regulations for investment firms to ensure that their employees have a higher level of training and compliance, to ensure that employees that are dealing with more sophisticated and exotic products fully understand how they operate and how they can be calculated, priced, and audited and disclosed appropriately, so that individuals can demonstrate that they are competent in dealing with these new products. Now, when it comes to training within financial firms, you can imagine this is an ongoing process. You don't get everything on day one, then you can forget about it. Of course, when you start, there will be some legal training that you'll need to do, such as health and safety. But obviously, specific to the finance sector, you will have the likes of anti-money laundering training and large elements of data protection training. But also, you may have training relating to the likes of ethics. You potentially might have had to have passed an ethics test or some sort of psychometric test before actually starting employment. So you'll receive certain levels of training regarding ethical behaviour. You might be given the principles that your firm operates, and that to ensure that you fulfill your duties within that sort of principles and culture of the organisation from an ethical point of view. Now, the likes of the FCA have certain rules on how we can demonstrate competency. For instance, before joining the firm, depending on what level, you might have passed appropriate examinations, whether this be from professional bodies such as the Chartered Institute of Security Investment or the Chartered Financial Analyst professional body. Certain roles may require you to be a member of a professional body, and certainly in the advisory sector you have to have certain levels of professional body qualifications before you can advise individuals by yourself. And the likes of these professional bodies have numerous levels and pathways dependent on what sector you work within. And these professional bodies work heavily with the likes of the regulators and the firms to ensure that their examinations and syllabus are appropriate. And some of you guys that have looked into grad schemes and placements, you might have seen that they don't require any professional body qualifications. However, what you'll see here is regulations are put in place that you must complete certain levels within 30 months of starting your employment. And this is to ensure that you have the levels of competency needed for the role that you're going to be conducting. Then, when you demonstrate that you have this competency, how do you maintain it? Well, each firm will have its own rules when it comes to continuous professional development, also known as CPD. If you're a member of a professional body, then to maintain this membership, you have to log and maintain CPD on an annual basis, and in some cases, they are mandatory requirements. For instance, the Chartered Institute of Securities Investment, depending on what level, there is a mandatory requirement for the level of CPD activity you must do during the year. And also, part of that mandatory requirement is a certain number of hours dedicated to financial ethics. But if you're not a member of a professional body, then individual firms will have a sort of training CPD log where you'll have to maintain certain levels of CPD throughout your employment, and each year you'll be given regular training. If new products become available, you'll be given the technical knowledge for that product before you can work on them. And this may be alongside the gaining of professional body qualifications. And instances where the likes of regulation changes, all relevant employees must be given the appropriate training in the new regulations and how these regulations actually impact the way they operate. Post-financial crisis, there was a big change in regulation in the advisory sector, which was known as the RDR, the Retail Distribution Review. And this regulation was to ensure that all financial advisors had a level of competency at giving out financial advice. Now, what this actually created in practice was you had lots of financial advisors who worked in the sector for many years and hadn't actually passed any formal qualifications, but they just had years of history and they knew how to do their job effectively. But this RDR regulation required these individuals to upskill and gain the qualifications for the job that they've been doing for years. So quite frankly, a lot of the older advisors really didn't want to do that and kind of just dropped out of the sector or retired, which left a pretty big gap, which the likes of investment firms or personal wealth firms are trying to fill by recruiting younger graduates and then putting them through such training. And lastly, all of this needs to be checked. Firms and professional bodies need to keep records of their employees' training history, their previous qualifications. So if asked, they can demonstrate that their staff do fit this competency requirement under fit and proper. And quite a lot of the professional bodies do work heavily with the firms so that if an employee has CPD with a professional body, then this can be sent to supervisors within the firm to satisfy that individual has kept up CPD, whether that be through a professional body or through the firm, so that the employee doesn't have to do two types of CPD to satisfy both the professional body and their employer. And this has only recently changed over the number of years as technology has advanced. But this record keeping is very important because the regulators can audit individuals and go to firms to say, provide what evidence you have of continuous professional development of your employees. Now, the last test for fit and proper was financial soundness. Individuals that work within the financial sector need to demonstrate that they can look after their own finances if they're going to look after someone else's effectively. So this is where you would potentially get credit checked at the start of an employment, and you'd have to disclose any sort of declared bankruptcies at the start of employment or during your contract of employment. So as you can imagine, the regulators have a view of individuals if they can't demonstrate their own financial soundness. Are they appropriate to work in the finance sector? And there could be a more cynical view. If someone has been declared bankrupt, then at home they're in a certain financial situation that might put additional pressure on them, and this additional pressure could lead to financial crime. So if they work within a firm, they could potentially manipulate what they do to retrieve extra funds from the firm. And this is one of the corners of the fraud triangle. Now, let's ask a question. If someone was declared bankrupt 10 years ago, does this mean they'll not be approved as fit and proper, whether it be from the FCA or a relevant conduct authority in another country? What do you think? Well, the answer is not necessarily. 10 years ago was a long time away. The likes of bankruptcy would normally sit on your profile for 5 to 6 years in the form of a credit check. You might declare that you're bankrupt, but obviously you can talk about the mitigating circumstances of why that happened. Now, we know everyone's human, and bankruptcy may not be due to your own misdemeanor. It could be due to a relationship breaking down. You could be a victim of crime yourself that led to this. So these sort of circumstances can be taken into account when looking at bankruptcy. Now, the regulator may then go ahead and approve that you're fit and proper, but they may serve a warning notice to you and the employer and give you certain levels of criteria or extra supervision that may be required during the first few years of your employment to ensure that you are fit and proper and meet this financial soundness criteria. And lastly, for this section, let's answer this question. What would you consider in assessing the first component of the fitness and proper test? Someone's honesty, integrity, and reputation is considered as what? A, B, or C? Thank you, and that concludes the first part of this lecture. Hi there, and welcome to part 2 of this lecture on the authorization process for firms and individuals. So in the first part, we looked at the old school fit and proper idea and the principles behind that. In this part, we're going to look how that's now evolved and changed from the immediacy after the financial crisis and now into something different, which only really came into effect fully in 2019. So, during the financial crisis, as you can imagine, there was a lot of press and media interest in the conduct of individuals and certainly management. Going back to the previous part, we talked about Bob Diamond and the media's interest in his conduct and how he steered Barclays through some of their recent scandals. So the then regulator, the Financial Services Authority, looked to introduce the significant influence criteria on top of fit and proper. So this is an extra level of scrutiny required for certain individuals if they worked in more important levels within the institution. And we'll also cover what the different 5 control areas are and which 4 of the 5 require this extra level of scrutiny. And the last point on this slide refers to the proprietary traders. Now that means traders that use the bank's own money rather than clients' money to make investment trades. Thus, these individuals, if they weren't classed as senior managers, would also have to be part of this significant influence requirement because it was seen as the proprietary trading of the banks which were the most risky element. So, how did they evolve the fit and proper during the financial crisis? Well, what they did was they split it into 2 and called it the approved persons, where everybody has to satisfy the criteria on this slide. But as you can see, the language is very similar. You've got the word integrity there, but we've got act with due skill, care and due diligence. But to normal people and naive people, then ultimately that sounds very similar to what we had before. And on the whole, it is. But it also extended this to be more open. So the last element was that all individuals must be seen to be open and honest and are willing to cooperate with regulators if there's ever a case of intervention from regulators. But this is the next element that was added for individuals who play a more significant part within the organisation. But as you can see, the language again is still very similar. It's just at a higher level. So the first bit is that the management need to take steps or put a culture in place to ensure that the firm itself is accountable and that it is controlled in a more efficient manner. The managers have to act in, again, skill, care and due diligence whenever they conduct higher level business, and it gives that extra level of accountability to this function of management. And that the managers also need to take extra steps to be compliant when it comes to meeting industry norms and standards and requirements from regulators. So all this language does still sound very similar to fit and proper, but they just added in elements of more accountability, certainly at the senior management, and that it's the senior management's job to instill a certain culture and I suppose lead by example. So here's a question. In one of the first principles of this approved persons regime, you're expected to act with integrity when you carry out your accountable function. In other words, managers with this new level of regime must comply or demonstrate that they have a certain level of integrity when they conduct their role. So which one of the following would be an example where they have not conducted their level of responsibility in a way that would demonstrate integrity? A. Failing to report promptly in line with their internal procedures when asked by the FCA if anything. B. Failure to take responsible steps to adequately inform yourself about the affairs of the business which you are responsible for. Or C. Deliberately misleading the firm's auditors about admissions. So, what are these control functions that we've been referring to? So within a financial firm, the regulators have divided the firm up into 5 different controlled functions. In other words, 5 areas of responsibility for certain employees, or 5 parts of the business, we'll say. Now the first 4 on here are all control functions that require the approved persons principles as well as the significant influence function principles. So essentially the first 4 have to do all, but the latter function, the customer dealing function, they only need to do the approved persons sort of level of authorization. And just to recap, the approved persons level is just that they must act in due care, skill and due diligence whenever taking their role out. They need to be honest with regulators and that they have to work with integrity. But the first 4, which have the significant influencer function requirements, these are individuals who must take reasonable steps to make sure the business is run in an integrity way. They must set a good culture. They must act again with skill, care and due diligence in the way they operate their management function, and that they must be seen to comply with all the regulatory requirements. So let's have a quick look at each function and what this may include, but do take your time yourself to have a look at the slide and potentially research what each function may do. But as you can imagine, the likes of the governance function, these are the individuals at the top of the firm, such as the directors, the non-executive directors. But if it is a family firm, then of course the family themselves would also class as the governance function. The required functions are the functions that essentially oversee the elements of risk management. So these tend to be your compliance departments, your anti-money laundering department. You're part of the business that is responsible for managing your overseas operations and the function that oversees the likes of your client's assets, or technically is the owner of your client's assets while under management. The other three types of controlled function, if you read the notes to this slide, it gives you detail of each one in turn. But we have like the systems and control functions. These are essentially the IT systems, the payment systems, the auditing functions. The significant management functions are not the managers at the high level, but you can imagine these are kind of like your middle managers, or if they may be the head of equity trading, or head of settlement, or head of procurement. So some sort of middle manager or head of individual departments, but do not fall under the governance level, would be your significant managers functions. And then lastly, you have the customer dealing functions. So these are the individuals who are not required to do the significant influence function, because these are typically your lower levels members of staff who deal with customers more in a face-to-face manner. And as you can imagine, the employees at the lower level, okay, they need to obviously conduct, in a way of due care and skill, but obviously their role wouldn't or shouldn't give them the opportunity to significantly impact the bank if they were to act in an improper manner. So let's ask a question about these functions. So you're now the compliance manager of this authorized firm, and you've been required to recruit a new employee responsible for money laundering reporting, this being the money laundering reporting officer, which is a very crucial role which we will cover in this module. You inform the managing director that this role is quite a significant one, and therefore they have to be appointed with approved person status as well as the significant influence status. So which function do you think they will fall with under out of these three? The required functions, the significant management functions, or the systems and control functions? So now moving forward, the rules have slightly changed, and these are the current rules that are in place right now in the UK financial system regarding the approved persons. But again, their roots are really from the previous examples. So their roots still kind of come from the fit and proper, and then they go on to the approved persons regime and the significant influence regime. Except from now, it's been broken down into these three concepts. So you have the new conduct rules, which as you can see is the lower level, so that's pretty much everybody in the firm. Then you have the certification regime, which is for staff at the next level. And then at the top you will have the senior managers regime, which, as you can imagine, will be the individuals that we talked about in the higher controlled functions a moment ago. So let's have a look at them individually. Now the lower level is the conduct rules, but as you can imagine, they still follow the same principles we've already discussed about honesty, integrity, skill, due diligence and care. Essentially, these rules want to ensure a higher level of standard of behaviour for almost everybody in the banking sector, but it adds the fact that firms should notify regulators if there's been any breach to these rules, and I suppose that adds to the level of transparency and openness. And if you are interested in what all these conduct rules are for individual staff, then please feel free to have a look at the notes in this slide and have a look at the FCA handbook to what that may contain. But essentially, it's using the same language as all the previous regimes we've just mentioned. Now the next level is the certification regime, and this is really aimed at individuals who could pose a risk of significant harm to the firm or any of its customers, given their level of responsibility. But interestingly, this would also kind of take into effect the likes of financial advisors, because these members of staff have got up to a certain level of qualification by professional bodies. Therefore, they may have more flexibility and freedoms to give advice that, say, someone that isn't qualified yet could do. But this level of certification may also extend to individuals who deal with trading and deal with large sums of money when it comes to the wholesale markets for financing. But notably, this is taken at the firm level, so individual firms have to ensure employees at this level fit the requirements of this certification regime. But again, it goes back to the previous language of acting with integrity, due care and due diligence and all that. And then finally, we have the higher level, which is the senior management regime. And as you can see at the top, this has only recently been fully implemented. And this really focuses on raising the standard of the individuals at the tops of firms. But again, their roots are steeped from the previous significant influencer status. So it will take into account all them requirements of setting a good examples, setting a good culture, being responsible for your business and being accountable. So most managers that hold a significant responsibility within the firm, certainly at the governance level, must achieve this the senior manager's regime status. So, who is exempt from all of this authorization process? Well, obviously this authorization process is specific to the financial sector to start with, but there's large elements of the sector which you could say are unaccountable for. So the likes of multi-level marketing schemes who, through self-employed means, fall outside of this regime of authorization. So the likes of a multi-level marketing scheme, this is where you would potentially employ someone to work underneath you to sell, and then potentially that person would employ someone to sell, and so on, and the proceeds slowly make their way back to the top. So the more people you can recruit, the more revenue streams you would receive. If you want more information on what multi-level marketing schemes are, there is a very good BBC documentary on this sort of activity and how its history, or where the companies tend to originate from, in Utah in the US due to their Mormon faith. That documentary is worth a watch. There's also instances where the likes of fintech companies and apps that people trade on, a number of these firms are not potentially authorized to operate in the UK by the PRA, so they may also fall out the remit of this new approved persons regime. Individuals who work for professional firms, which could be solicitors, accountants, and actuary, insurance, because they're separate from the finance sector and they're subject to their own governing body rules and regulations and levels of integrity, then they wouldn't be required to go through the FCA's authorization process because they will have already gone through one for their own professional firm or professional body. And also, local authorities and government also fall outside the remit of the PRA and the FCA in the UK. So just to recap the last two parts, we've talked about how the approved persons for individuals has changed. So we started with the fit and proper, and then we went to approved persons regime with the significant influence functions on top, and then we've ended up with this 3-tier system which has the new conduct rules for everybody, the certification regime for the middle management and heads of department, and then finally the senior management regime, which is more at the governance level. But ultimately, from these two parts, what you can see is the language is still the same. You must keep good integrity, and how do you demonstrate that? You must have a certain levels of knowledge. How do you demonstrate that? How do you maintain that? And if you're at the senior management, you now have to demonstrate how you act on behalf of your business and the culture you set within your business. So despite this transition from fit and proper to this 3-tier system, the language and the process is very similar. It's just the way it's conducted and who falls under what level has changed. And that concludes this part on how individuals are authorised by the regulators. Thank you. Hello there, and welcome to this final part of the lecture on how individual firms and businesses are authorised by the regulators. In this final part, we're going to cover how firms are authorised to conduct their business within the financial services sector. We'll look at the minimum standards required, how they keep and maintain this authorisation, and look at some of the exemptions. Now, the content of this remaining lecture really focuses on the points of view from the UK financial regulators. However, these principles are pretty universal. It doesn't really matter whether it's from the UK point of view or a more global point of view, because the principles of being authorised as a firm do resonate very similar around the world. Now, yes, there are some countries where authorisation to work in the financial services sector and open a business is a bit more laissez-faire, but the principles we're going to discuss are from a UK point of view, but they do have much bearing on other major economies around the world. So in the UK, under the FCA, the Conduct Authority, they have something called PRINs, which is the Principles for Good Business. If you look in the notes to this slide, there's a link containing details with the handbook. And these PRINs outline the obligations of firms that are regulated and how they should conduct their business. And again, these similar words appear. They must demonstrate honesty, fairness, and professional conduct at the firm level. One of the key elements of the Principles for Good Business is the concept of TCF, treating customers fairly. But we'll cover this more next week when we look at how financial firms should treat their customers. And we're going to cover 11 different principles in which firms must demonstrate that they match so that they maintain their ability to conduct regulated activities. Now, what do we mean by regulated activities? Well, the majority of this is the general business of working within the financial sector, and it also covers elements such as client advice, whether that be individual advice to individual clients, or whether that be from a investment banking point of view and advice on the likes of enlisting on stock exchanges or mergers and acquisitions. And it also includes the likes of trading and proprietary trading activities. So, what are these 11 principles? Now, as noted earlier, these are specific to the UK context. However, look at the language used. It's very universal, and this could easily be the likes of an examination question when we talk about what are the principles of good business. Okay, this is what the UK regulator says, but look at the language. It's pretty universal. So the first one, there's that word again, integrity, but obviously at the firm level. How on earth do you demonstrate this at the firm level? Well, obviously a lot of firm culture and reputation will play into this. The second one, skill, care and due diligence. Again, at the firm level rather than the individual level. Number 3 is about management and control, but it's really referring to the legal responsibility of managers to ensure that the firms conduct their business in an appropriate way. Number 4 is financial prudence. Financial firms must demonstrate that they have the capacity and the ability to conduct its business in a way that its financial resources are safe and that any risk-taking activity that they do is backed up with a good capitalisation. Number 5 is all about market conduct. Firms must demonstrate that they're observing standard market norms and they're not trying to manipulate the market or dominate the market, and that they're a fair player alongside its peers. And number 6, which is linked to treating customers fairly, is that it has to demonstrate what it's doing is in is in the customer and public interest, and that when they've created products, the products are there to fill a customer need rather than having an alternative motive of excess profit or helping remuneration packages for the sellers or for the management. Number 7 is all about communication with its customers and its clients. Again, we'll cover this in more detail in a future lecture. This is where a firm must provide clear and fair and not misleading advice or advertising or marketing to its customers to ensure that any product it sells is fully explained and all the customers are aware of the level of risk they may be taking. Firms must demonstrate that they have conflict of interest policies and that whenever the likes of a manager is doing something, it isn't to suit their own need, it is there for the clients and the client's interest. So they must have the likes of a conflict of interest policy. Number 9 is all about trust, specifically when we're talking about advisory. Financial advisors tend to have a certain level of qualification and they may have the backing of a professional body which tries to help demonstrate that they are trustworthy individuals. But the firm must take note of this and demonstrate how its advisors are trustworthy. Number 10 is all about clients' assets. So if you have clients' funds under management, you must be able to demonstrate how these funds are protected in the case of shocks or pressure on the firm's finances. And the last one is about the openness for the firms and the management when it comes to dealing with the regulators. Firms must have a transparent process and must comply with the regulators in a way to ensure that mandatory disclosures are given in a timely manner. As part of these 11 principles, the threshold conditions in the handbook lay out the minimum standards that firms must adhere to ensure and maintain their authorization from that regulator. And as well as these 11 principles, they must have clear systems and controls in place to demonstrate to the regulator that they are meeting the threshold conditions, minimum standards, and that they are adhering to all 11 principles. As you can imagine, these principles are put in place to avoid the likes of reputational damage for firms, to prevent them from taking excess risk or even collapsing in the case of Barron's Bank. Within the principles, there is an emphasis on managers to take appropriate responsibility for the level of job they have. I'll give you a recent example of where a lot of these principles were challenged in the case of Wells Fargo. So Wells Fargo very recently were accused of opening customer accounts in customers' names without the customers knowing. So think of what principles or prints that goes against. Why were they opening these accounts? Well, it was to hit targets. The more accounts they opened, the more money or remuneration the front line would get for opening these accounts. So if we look at the principles, is that acting with integrity? Was there any management control? Did the managers question why all these accounts were being created? Market conduct. Well, let's think about that. That's trying to outperform your peers from a competitive point of view. So is that really adhering to good market conduct? Clearly it's not in the customer's interest. You're not treating them fairly. You're not even informing them you've opened up accounts in their name. And that also leads to poor communications with the customers. If they were doing it for financial motivations, is that not a conflict of interest? And let's be honest, they probably weren't telling the regulators this neither. So very quickly, nearly all of the principles of good business in that one example were ignored. If we think about they should have had systems and processes in place to maintain minimum standards. Well, were these systems actually effective? If all these staff were able to get away with opening fake accounts, who's doing the due diligence or auditing these accounts? So they're the minimum standards were ignored, and potentially those failings in the systems and controls in place to ensure that they fulfill all 11 principles. Now, who is exempt from these principles? Well, firstly, one that's not on there is actually for education purposes. So me, I guess, or me as or the university as a firm, we're exempt because we do it for educational purposes. But some firms really bend the rules when it comes to educational purposes. And I'm really thinking about the fintech sector here. If we look at the likes of eToro and other equivalent firms, they'll have an educational platform with them. They'll tell you how to use their platform. They might give education about trading strategies. But is this not really blurring the lines between advising and education? I'll let you think about that next time you use one of these services. There's other things like the media. The media are exempt from this. I usually give an example of likes of Martin Lewis. Now I'm fully aware that he owns a financial firm, moneysupermarket.com. Well, he doesn't own it because he sold it to one of the compare sites. But think about, is he giving out advice when he's on the TV? Is he qualified to give advice? I personally don't know if he's got actual financial qualifications, but it's that sort of person that quite a lot of people actually follow and listen to the letter. But technically, anything given in the media when it comes to financial advice is exempt. I know it's a bit old school, but newspapers, I don't know if they still do it, but have like financial tips of the week. Social media, there's quite a lot of individuals and firms on social media giving out advice or investment groups. They don't need to be authorised in this way. Another category is overseas persons. So if you are the regulated firm in the UK, but you have like a collaborative venture or a subsidiary overseas, then technically that overseas subsidiary may be exempt from this authorisation process. And also, the likes of trustees, nominees, or personal representatives of individuals. This could also be in the case of wills. They're also exempt from this kind of authorisation process, whether that be individual or firm level. When we're talking about the firm level for authorisation, now there is a little bit more detail on what constitutes as a firm, because as you can imagine, the larger firms are subject to more regulation than the smaller firms. Again, that comes back to the principles of good regulation and proportionality. And in the context of the UK, they're categorised C1 to 4, with 1 being the larger firms. And these should also constitute the CIFIs, the systemically important financial institutions, or the GSIBs, the globally systemically important banks, and also the DSIBs, domestically systemically important banks. These should all be categorised as C1. And obviously, as we go down the scale, it tends to be lower categories of either size of customers or assets under management, or in fact what they actually do and how they operate. So you can see that you got C2 there, which constitutes the majority of large to medium-sized firms. You've got C3, which is more the smaller customer bases, and then you have C4, which is really the smaller firms, and potentially the likes of intermediaries who really don't hold customers' deposits, but they act as providing a service. From the conduct supervision's point of view, they try to maintain like 3 kind of pillars when it comes to authorization. The first one being firm systemic frameworks, and this is really focused on, are they acting in the customer's interest and upholding market integrity? And that again comes back to the principles of treating customers fairly. Historically, the regulator has kind of been driven its authorization based on previous events, so it'll learn from the past. Okay, last week we talked about their ambitions to be more forward-looking, but quite a lot of these principles tend to be more reactionary. And what you can see earlier on from the changes from fit and proper to the free tier system. This was basically driven by previous events and previous wrongdoing, but they also determine the level of authorization depending on the level of sophistication of the products and the knowledge required when selling or using such products. From the prudential regulator's supervision point of view, we talked about last week how they like to have a judgment-based approach to authorization and regulation, and this judgment is based on how well and sound they feel the firm is, and this could be based on stress testing and historic examples. In the event that the PRA has to do any sort of intervention, whether a firm either fails to meet its PRINs and the minimum thresholds, or whether the firm is in distress and fails its stress tests, the regulator has a proactive intervention framework that has 5 stages. As you can imagine, as the scales go up, this really increases the amount of regulatory pressure that the firm has on it to ensure that it doesn't collapse. And obviously, the likes of stage 4 and 5 is really why we have all this regulation in the first place. Because ideally, regulators don't ever want to get to stage 4 or 5. Because historically, if we look at these stages, what happens? Last week we discussed why firms in the financial sector are important to the economy because they create wealth. If you get into stage 4 and 5, then the likes of a collapse or large-scale media interest in the stability of the financial sector, then this results in the likes of government intervention, potentially bailouts, which could create moral hazard in the sector. It could result in forced mergers and acquisitions, where another bank is forced to buy another bank to prevent the other bank from failing. We've seen that during the financial crisis in the case of Halifax being bought by Lloyds, and obviously in the severe case where we would actually just allow a bank to fail, but potentially the government could buy all the bad assets to ensure customers are protected. So that concludes this lecture on how the likes of a conduct authority or a prudential regulatory authority would authorise firms or individuals to operate within the financial sector. As part of your directed study for this I would like you to go to the relevant regulatory body website to revise their authorisation process. We have the journal article by Ford there, which gives you a very reactionary piece to regulation at the time of the financial crisis. And very shortly within the Blackboard site under the exam help folder, I will release the exam question, practice question 1, for you to go ahead and attempt. And next week I'd release the answer. Thank you for listening and all the best.